What's up guys, Jake here. In today's video, we're going to do another trading options tutorial, and this time with the brokerage firm Vanguard. And in this video specifically, we're going to go over an example how to sell to open a cash secured put on Vanguard's platform. Now, if you want to learn more about selling cash secured puts, check out this video in my options trading playlist. This goes more into detail about the theory and strategy behind it. But in this video, we're talking about Vanguard. And Vanguard is one of the largest brokerage firms in the world. However, their website and their app are not state-of-the-art. They are not up to date. So I'm going to show you how to do this with screenshots because on every page it shows my full name and my account number, and that's a hassle to blur. So I have some screenshots for you here, and I'm going to show you exactly how to sell cash secured puts with Vanguard. First thing you should probably do is enable margin with Vanguard. That's something you have to apply for. Once you're approved for margin, you then can go to the buy sell page, click trade options. It's then going to give you a pop-up saying, hey, you haven't been approved for options yet. So when you go through the prompts, click on the link, it'll then tell you how to apply, how to submit an application to be approved for options trading. Here, once again, is their step-by-step process. You're going to have to answer some questions and give some information. What you want to tell them is up to you. And they have 4 levels of options trading. Option 1 is income and hedging. This includes writing covered calls, but for some reason, selling cash secured puts, writing cash secured puts is income and speculation level 3. So that's what you want to get approved for. And after waiting a couple days after you're approved, you can go back to the buy and sell page. Once again, click on the bottom, this text here that says trade options. And this is their options trading window. And it's not very intuitive. It looks exactly like the buying stock or ETF or buying the mutual fund window. You basically have to know what you want. Their user interface isn't going to be very helpful. So since we know we want to sell to open a cash secured put, you're going to select puts. Then for transaction type, go to the drop down and we're going to click sell to open. To then find an expiration date and a strike price, there's a hypertext here that says choose from a list of options. Go ahead and click on this. And this is what Vanguard's option chain looks like, and it's not very good in my opinion. So there's a drop down for the expiration date. For this video, we're going to go with May 21st. The third Friday of the month always has the most liquidity, the most people trading options. So that's about 1 month from today, which is a good time period to sell a covered call or sell a cash secured put. Now, the current stock price of Bank of America is $37.96. So there's a scroll down here where you can basically click on these and then it'll populate over here. And it's showing you in the money options, which are shaded yellow, and out of the money options, which are shaded white. And we have the buyers bidding, people buying calls are buying this amount, and people buying puts, and people selling puts are offering this amount. They want to be paid this much. So why might you want to sell a cash secured put on Bank of America? Potentially, you want to open a position because you think Bank of America stock is going to keep going up, but you want to get paid. You want to be paid to buy the stock you want to buy anyways. So currently, Bank of America's stock has gone down from $40 a share to $38. Maybe you're saying if it goes down to $37.50 or $37, I want to buy 100 shares. I think that's a good price to buy Bank of America stock. Or you don't want to you don't want to buy the stock. You just want to collect the premium. You're willing to buy the stock, but that's not your goal when selling a cash secured put. So if the price has recently dropped $2 a share, you might be thinking, okay, this pullback isn't going to last. It's probably going to shoot back up tomorrow. This is a perfect time to sell a cash secured put, not have to buy the stock, and just collect the nice premium. Now, unfortunately, when trading options, it's very useful to reference the Greeks, at least delta, the probability of being assigned on the contract, and IV, the implied volatility, that's how you know if you're getting a good price for the premium of the contract. Vanguard does not offer you those metrics, those Greeks. If you want to reference those, you have to go on a third-party website. So for fun, let's go on Robinhood and reference their Greeks. So we'll type in Bank of America Corp. We'll then go over here and click Trade Bank of America Options. And we are on the Vanguard platform selling a put that is expiring on the third Friday, so May 21st. So what it's doing is it's showing us the share price currently, 38.12. And we're looking at the closest out of the money and in the money puts. Now, when selling a cash secured put, if it's above the current share price, the strike price is in the money, and if it's below, it's out of the money. So if we don't want to be assigned, you want to go farther away from the current share price going down. You want to be below the current share price. So if we click on 38, it'll show us delta, and delta serves two purposes, but when referencing delta, it's a rough probability of your chances of being assigned. So if we sold a 38 strike price for May 21st, and the delta is showing 0.46, there's a 46% chance we're going to be assigned, that the share price in a month will be below $38. Now, if you want to be assigned, go ahead and choose an at the money option. Basically, you're more likely to be assigned. But if you're just trying to collect the premium and not get assigned, let's check out the strike price, $37.50. It's showing us a delta of 0.40. Let's go down to a strike price of 37, and this is giving us a delta of 0.34, so a 34% chance. When selling covered calls or selling cash secured puts, if you don't want to be assigned or lose your stock, then going for a delta value of about 30% is the sweet spot. Next thing you can reference is implied volatility, and this shows how volatile these option contracts have been recently. So currently, for the strike price of 37, IV is 28%. When you're the seller of option contracts, you want this to be higher. You want this to be 40, 50, 60% because you're getting more premium for selling this contract. You're assuming more risk that the share price can move around and you could be assigned. 28% isn't a good IV. In the 20s is pretty much average for a very calm stock. Bank of America is a blue chip large stock, so this is very stable. These are very stable prices. But I still like this stock. I still want to sell a cash secured put, so I'm going to choose the strike price of maybe 37. Okay, we're back on Vanguard's platform, and actually I changed my mind. I want to go with the strike price of $37.50 to get just a little bit more premium for selling this contract. How do I know how much I'm getting? Well, it says right here, the bid, 99 cents, the ask, $1. So buyers of these put contracts are bidding 99 cents, the sellers are asking $1. The spread is very small because this is such a large company that's frequently traded. So one contract represents 100 shares. So if I go where the buyers are bidding, I can get $99 for selling this cash secured put. So let's do it. Let's do a quantity of one contract. This represents 100 shares. Order type, you can do a market order, but I recommend doing a limit order and then trying to get it filled where you want to get it filled. Limit price, 99 cents. Duration, we're going to do just during the day. Looks like the commission for the trade is $1. So I'm being paid net for selling this cash secured put, $98. Okay, it took a minute to get filled, but it's showing up in my account now with Vanguard. And once again, symbol BAC, P for puts, strike price $37.50, and this expires on May 21st, 2021. So let's talk about what has happened in my account. I only had about $5,000 in my Vanguard account, and it now says funds available to trade 1,347. So what it's done is it's used how much I have to purchase the stock as collateral for the contract. So the strike price being $37.50 multiplied by 100, I've locked up $3,750 worth of collateral should I be assigned. Should Bank of America stock go below $37.50 by May 21st, and I have to purchase this stock. So if I was paid $98 for the contract, why don't I have $5,098 in my account? It's because this put contract still has negative value, $95. Now what's happening here is theta decay and the remaining extrinsic value. Currently this contract has no intrinsic value, it's out of the money. But slowly over the next month, the current balance for this put contract is going to start going down from negative 95 to negative 90, negative 70, negative 40, as the remaining extrinsic value wastes away. Then my account balance will actually go up, and it'll show that I have a balance of $5,098. So the most money I can make from selling a cash secured put is the premium for the contract. If by expiration it expires out of the money and it's worthless. So how much money? How much money can I make selling cash secured puts? And this option is for a month from now, and I'm making about $98. So 98 times 12, we'll just do that math really quick. And that's 98 times 12. That's $1,176 on locking up collateral of $3,750. So do 1,176 divided by 3,750, and I'm getting a 31% return on my money, on this collateral that's getting locked up. If you can earn 31% in the market for a stock, that's pretty fantastic. However, we have to remember that the delta value was about 30%. So a third of the time I'll be assigned Bank of America stock, and I'm okay holding it because perhaps it'll go back up a week later and I didn't lose that much. Or I just sell it at a loss and then I repeat the process. I keep selling cash secured puts even lower for more income. So over the course of a year, how much money, how much percent return on my equity could I earn? Probably close to 20%. Selling cash secured puts is pretty cool. And of course, if you want to exit this position early, let's say after 2 weeks you've already captured 70% of the value of the contract, all you have to do is buy to close it. So you sold to open a cash secured put, and if you buy to close the exact same contract, they will cancel out, so your quantity here is -1. So if you buy one, it'll go back to 0. You have no longer any obligations, they cancel out. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, check out my playlist on trading options. I have more tutorials and explanations there. If you have any comments or questions, let me know. Until the next video, take care.